Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. I'll be your host today. Today we've got Gary Savage with us, another technical chartist that looks at the markets. And I wanted to bring him on to get his opinion, what he's seeing in the market, seeing if it aligns with what I see too. So Gary, thanks for coming on. I really appreciate it, taking the time to jump on my channel. So thank you.
Yeah, thanks for the invitation.
So Gary, can you give us a little bit of your background, kind of how you got interested in the markets, maybe stocks or precious metals? What kind of led you into the markets?
So, interesting story. I got interested in the stock market in 2000 during the bubble. Had no idea what I was doing. Of course, lost a lot of money. Got caught in a bubble, as most people do, and decided to study and figure out what went wrong, why I lost money. And it's been a long process, 23 years now. But over time, I've developed a system that works for me, and I try and teach people in my newsletter kind of how to use my system, and they can either learn that or incorporate it into things that work for them as well. So mostly I'm cycles and sentiment based is what my systems are built around.
Okay, can you describe a little bit about your actual system? Uh,
So large markets like the stock market, the gold and metal market, or the metals markets, energy, they tend to have cycles just like the weather. We have seasons, and it's just based on human emotions. People tend to go from one extreme to the other. We don't kind of stay, in a neutral position. We get either overly optimistic, which is what creates bubbles, and then when the tide turns, we become overly pessimistic. That's what creates bottoms, and you'll have more moderate forms of that is what gives you these cycles. There's a for instance, in this actually in most sectors there are daily cycles which tend to be a little bit shorter. Like in the stock market, the daily cycles roughly 35 to 45 days long. And then you have longer intermediate cycles in the stock market. That's usually 20 to 25 weeks. You'll have a yearly cycle anywhere from 11 to 13 weeks. And then you have multi-year cycles. In stocks, that multi-year cycle is generally runs about 3.5 to 4.5 years in duration. This is from trough to trough. And then in the metals, it's a longer cycle. It's about an 8-year cycle.
okay, and given what you use using your cycles kind of in the longer term, where do you think we are today when you look at those cycles? What's kind of the hot sectors and the overvalued and undervalued sectors in the markets today?
Yeah, so we've got some interesting areas that are just coming out of major cycle, multi-year cycle lows. Commodities just finished their 3-year cycle low. I think it was either end of May or beginning of June, and oil is the major driver of the CRB. So that's why oil is starting to advance again. Despite the Fed raising interest rates, they're not going to be able to stop the advance in oil. They'll probably make it worse because it makes it harder for energy companies to expand. It's harder for them to get money. Um, so we're starting the second phase of inflation. The first phase obviously was coming out of 2020 to that top when Russia invaded Ukraine. And then we had a corrective phase. And now we're starting the second phase of inflation. Um, Gold, on the other hand, has an 8-year cycle that bottomed in October of last year. So it's leading the commodity sector. It bottomed before commodities did. We're now in the advancing phase of a new 8-year cycle in gold. We had a very strong initial period as we came out of that October low. I think we went from I think it was about $1,600 to $2,100. So a pretty um, you know pretty large magnitude move in that initial move. Now we're in that was an easy phase. Now we're in a difficult phase where we're consolidating that move. At some point here, this difficult phase, this consolidation will be over, and we'll start the next leg up, which will break out above that 2100. I guess it's about 2090 resistance zone, that triple top. Once we break out of that triple top, then there's no resistance above, and ultimately, I think gold. I think $5,000 gold is pretty much a given, and at some point, I think we'll have a bubble here, and I think $7,000 to $10,000 gold is easily achievable during a bubble phase. So the first hurdle, of course, is to finish this difficult sideways consolidation phase that we've been in for 3 years and break out. And then once that happens, then we'll be on our way. And I don't know how long it'll take to get there. It could happen quickly, like it did in 1980, over the span of a year and a half, 2 years, or it could take 6 years to finish that bubble phase. But once we break out, I think we're kind of in the beginning of that bubble phase. And like I said, I think $7,000 to $10,000 isn't an unreasonable price target.
You said
Stocks on the
we're in. Oh, go
well,
ahead.
I was going to yeah. Let me finish with stocks. Stocks, on the other hand, are in a different position. We're getting late in the 4-year cycle, so you want to be a little bit careful with stocks. You don't want to get caught in the move down into that 4-year cycle low. As we were discussing before we started the interview here, um, I think if stocks can finish this intermediate cycle low that they started a month ago, then that would be a good buying opportunity. And we might even test those 2021, 2022 highs. But I don't think we're going to get a sustained breakout above that. And then I think we're going to have a really deep correction that probably go below the October of last year low during that 4-year cycle low. So stocks a little bit iffy. If we can finish the correction, I think you've got a tradable rally, but they're not in the same position, I don't think, as gold and commodities, which are at the very beginning stages of a multi-year cycle advance. For stocks are we're getting late in that multi-year cycle, so they're becoming a bit dangerous.
You said we've got the first kind of wave or phase of inflation, then we've got the second wave or phase of inflation. Is this the bigger wave compared to the first wave?
Um, it could, well, probably not bigger in percentage wise, because the biggest gains come at the very beginning of a bull market. So oil went from, what was it, like minus $35 to 100, and I think it went to $135. I don't think you're going to get that kind of a move again. That's a mind-blowing move. But the biggest gains in a bull market come at the very beginning, and then also at the very end when you're like in a bubble phase. Uh, I don't know that this 3-year cycle in the CRB is going to produce our bubble phase. We might have another corrective phase, and then the bubble phase where oil goes to $250, gold goes to $10,000. I don't know. The biggest gains are at the very beginning, so you've kind of already missed that part. But there's a lot of potential between now and the final. I think the commodities will have a bubble phase at the end. I think gold will have a bubble phase. Oil will probably have some kind of a massive move up that'll probably trigger the next recession.
Do you think interest rates have any impact on precious metals or commodities or anything like that here? If they continue to raise rates, is it going to slow it down? Is it going to delay it? Kind of what's your opinions around that?
So I would say interest rates almost no impact on oil. In fact, they may make it worse for oil, as it makes the cost of money more expensive for energy companies, so harder for them to expand production. Very little impact, I think, on metals in the longer term. Short term, maybe. Longer term, we saw the last bubble in gold occurred alongside double-digit interest rates. So historically, I don't think they have that much impact on the metals, but they may have some impact short term.
Do you think there's greater opportunities in energy versus, say, precious metals as we go up into this bull market of commodities? Do you think one sector is better than the other? Kind of how do you view,
Well,
what's
I
your
think
opinions around that?
I think there'll be periods where it's better to be in energy, and then periods where it's better to be in um, metals. Overall, I think silver is the most undervalued commodity on the planet right now. And between now and say a final top, I think your biggest gains are going to be in silver. I think we could easily make 1,000% or more in silver from the current level to the final top. Um, Oil, if it goes to $200, what's a little bit more than 100%. Uh, Gold, I think, has more potential than oil, because I think gold could go to 7 or 10,000, which would be what, 3 or 400%. So all in all, I think the percent or the potential is better in metals than it is in energy, or probably now maybe uranium. I don't track uranium all that much, but some of the uranium stocks might have the kind of potential as silver because they're so depressed. But generally speaking, I think the one commodity that you want to hold, and I would suggest physical silver and physical gold, but probably silver is probably, in my opinion, the most undervalued commodity on the planet.
Okay. And, what's your take on the mining companies of precious metals? Because a lot of people, they don't they don't have the propensity to hold the physical metals. I mean, I do. But what about the miners? What's your take on the mining companies?
Um, so the first thing is that mining is a crappy business. So it's not. I don't think it's something, and I think this is uh, a view that a lot of traders have, is that the mining stocks are just going to perform great over the span of a bull market, and they probably will perform pretty good, but I don't think they're going to be anywhere close to silver. So in my opinion, uh, first off, I don't trade individual mining stocks this that you can have a mine flood, a strike. Somebody, there was I don't even remember what stock was today, but I think it was down like 17%. And I made a comment, it's like, this is exactly why I don't trade individual stocks. Miners are good for trades. They're if you can catch an intermediate bottom, and I generally I just buy GDX, GDXJ, something like that, an ETF that's not affected by a company specific event. It's not going to drag down the whole ETF. And so they're good to trade the ETFs coming out of an intermediate cycle top, but then you want to sell them. If you can get pretty close to an intermediate top, buy at an intermediate bottom, sell at an intermediate top. Probably not a long-term hold, in my opinion. Just good for trades. Your long-term positions that you're going to hold for years. You want silver and gold, and in my opinion, you should have physical silver and gold.
Yeah, and what makes you think that the physical, at least physical silver, is going to outperform so much? Is it just completely the undervaluation? Is it a tightness in the market where supply, demand, and the deficits in silver are going to drive it? Or is it going to be related to people worrying about the currency itself, and people are just going to run over to physical? Like, what's your kind of your thoughts around that?
Well, it's more technical. You may have
Okay.
heard this expression: the bigger the base, the higher in space. So several years ago, I noted that it had been what, like, I think it took 16 years for the Nasdaq to break out above those that 5,000 level that it achieved in 2000. And before we even got to 2000 on the Nasdaq, I told people, I said, the Nasdaq is for sure going back to 5,000. And when it breaks out above 5,000, we got, a what, 15, 16-year base here. 10,000 is going to be a piece of cake because that base is so big, it's going to drive a big move. And 20,000 isn't out of the question. Well, we know now that we did get to 5,000. We did break out above 5,000. We went to 10,000. and we got fairly close to 20,000. I think we got to 16, maybe a little above 16. And I don't think we're done. I think, we have more to go in this bull market. So I think 20,000 is still achievable. So it was the size of that base that drove that prediction that the Nasdaq was going to 10,000 and probably 20. The base in silver is bigger than anything I've ever seen. The high was in 1980. We tested it. Was it in 2011? I think. Yeah, we
Yep,
tested
2011.
it, but we didn't break out. So we've got another test coming here somewhere, and that base is going to be, 40 years in making. So when that base breaks out, it's going to produce an insane move to the upside, and especially even right now, um, the gold to silver ratio is, I think it's 70-75 to 1. Well, at the top in 2000 or in 2011, I think that ratio had gotten down to about 30. So if you think that $7,000 gold, at a bubble top is reasonable, and you use, if you just assume that the gold silver ratio just goes back to 30, that would put silver at about 200, I think $260. Maybe that's right. Maybe it's $230. If gold goes to 10,000 and you use that same 30 to 1 ratio, then you're looking at about $360 silver. So, and when you get into a bubble, silver can literally move 200 or 300% in the last 6 to 8 weeks. So you could literally take a couple of years to get to $100 in silver, and then in the last 8 weeks you could go from 100 to 500. That's the kind of crazy moves you can get during these bubble phases. So the size of that base is what it drives my prediction that the move in silver is going to be mind blowing. And I think any purchase in silver below $30 is the gift of a lifetime.
Yeah, that's good. Yeah, so stick with physical. Follow that move, especially if the move is that big. Is there anything that can slow this move down? Is there anything that can stop it, slow it down, alter it that you can see or tell?
Well, obviously the Fed's trying to control inflation. I think governments have a vested interest in trying to keep the price of metals suppressed. They're kind of the canary in the coal mine. It gives the lie to the fact that they're controlling inflation. If gold is above $2,000, obviously they're not controlling inflation. So we've seen, the metal suppressed for years, but that can't hold forever. And I think it's probably in the process of breaking already. They're having trouble keeping gold below 2,000. And when they get it below 2,000, it doesn't go very far below it. We've been in a correction since May. And if you look at the long-term chart, the best they've been able to do is kind of just make it go sideways. They haven't been able to really knock it down that much. So I think the efforts to control the price of metals and that kind of, if you can keep the metal suppressed, and this has worked for years, if you can keep the price of metal suppressed, the rest of the commodity markets kind of stay in check. They don't really get out of hand all that much. But oil has kind of started to just ignore gold and silver. It's doing its own thing. A lot of the other commodity markets kind of the same thing. The CRB just went nuts out of that 2020 bottom, the first leg of inflation. So I don't think they're going to be keep the metals any longer or very much longer. I think they're going to lose that battle. It's going to break out above 2,000. And then it's going to break out above that 2090 top. And then at that point, I think it's hopeless. So, the governments have a vested interest in trying to keep the metal suppressed, but I don't think they're going to be able to keep it manipulated lower for very much longer.
I mean, we've got these gigantic bases, like you said. I'm sure you're referring to the cup and handle in silver. that we've got. It's just massive. We've got all these technical setups in commodities and precious metals that look very good. What do you think's driving this? Is this an inflation problem, or what's your opinion of what's driving all this? There's got to be something interconnecting all this.
So it's multiple things. It's inflation. The Fed has printed too much money. It's also a supply problem. So when we started the insane COVID policies, we
Mhm.
we created supply problems that are going to take years to correct. And in energy, it's worse because we've got it in our heads that we've got to um, destroy the fossil fuel industry before we actually have a credible source to replace it. So we're making policies that make it tougher to expand energy production, and that is a big driver of inflation. So it's a couple of things. It's supply problems. It's bad global energy policies, and it's and a currency inflation problem. All central banks are printing and have printed too much money, and we pretty much all countries have too much debt. They can't service their debt without continuing to print.
So if you were to look at previous maybe commodity cycles, do you think this cycle is more like the 2000s or more like the 1970s, or other cycles that you've looked at in history?
Um, Probably more like the 40s and 50s. Um, I think the 70s was kind of a money inflation problem and stagflation, whereas the 40s was supply problems along with that. But I think we are in a period of stagflation, and we are starting that second phase of the inflationary cycle. And usually, what leads the first phase of an inflation is not generally what leads the second phase. So the first phase was led by oil as it came out of that bottom from minus 35 to 135. So this leg of inflation is probably going to be led by a different commodity, which I think will be metals. And as I said, gold bottomed in October, so it's already leading. It didn't, you didn't see gold go back to $200 at that bottom. Gold held up pretty well. It dropped to, what was it, $1,400? I'd have to pull up my chart to see, but gold during that collapse in 2020, oil went negative. It went well below the last multi-year cycle low. It went below the 2000 lows. Gold did not held up much better than the rest of the commodity markets, and it's bottomed sooner. It made its multi-year cycle low sooner. So I think metals are going to lead this leg of inflation. So I think while you can make money in both, I think the big leader is going to be the metals, and I think silver is going to be the biggest winner.
Is there any other commodity markets that you follow that you think might do very well through this commodity bull market, like copper or whatever else that you follow?
I don't do anything with copper. I, I think uranium is going to do really well too. Although I don't know that it's a big enough market to have any kind of a dependable cycle, but it's probably something where you could just buy and hold for the long term. Again, I would just stick with the ETFs, like I think it's the URA. Um, I believe that's uranium mining. It's a basket of uranium mining stocks. So over time, I think that'll probably do good. I think you could also buy a basket or like an ETF, XLE, OIH long term. I think will do good. I like those stocks better than I would like metal mining stocks. I could, they usually pay, I think both those pay a pretty decent dividend. So I think you could take a long-term position in XLE and OIH, whereas I don't really think you want to take long-term holding positions in mining stocks. Those are more of a trade type vehicle. Again, the long-term holding the metals is just the physical gold and silver, whereas I think you can hold long-term XLE, OIH, um, and maybe USO as well. That's just a pure play on oil. Although I think it does have a little decay because there's some management fees in that, and they have to roll futures contracts for that thing. So there's some decay. So you might even be better off in XLE or OIH, which they are testing a long basing period too of about a year and a half. When that breaks out, I think they have some good potential as well.
Okay. Do you think there's a potential recession that's coming in the short term? There's a lot of people talking about a recession, the yield curve's inverted, et cetera, et cetera. Do you think a recession's coming? And whether it's yes or no, and I know it's hard to quote predict, what indicators do you look at to tell you if we could get a slowdown or not?
So usually there has to be a catalyst. The catalyst is almost always a spike in the price of energy, a spike in inflation. So the parameter I use is 100% in a year or less, 100% or more in a year or less. So generally, if the price of oil spikes that much in that short of a period of time, now if the price of energy rises slowly, the economy can adapt, people can get raises, they can cope with it. If it goes up too quickly, it's too much of a shock to the economy. It collapses the spending of middle class and lower class. There's an energy component to everything. So when energy goes up, everything goes up, food goes up, and when that's what causes the recession is when the middle class and the lower class all of a sudden, all they can afford is to put food on the table and, pay for the gas in their car. They can't afford to go to Starbucks. They can't afford to go out to eat on the weekends. They can't afford to go to the movie. And so the middle class and lower class spending collapses. That's what causes most recessions. Or we can do something stupid like closing down the global economy that will cause a recession. Hopefully, we won't make that mistake again. So I'm assuming that oil over the next 2 years, as we come out of this 3-year cycle low, is probably at some point it's going to spike high enough to trigger the recession. So it may be farther out than people think. I don't think we're ready to roll over into a recession right now just because the Fed has raised interest rates to 5%. I think you need another catalyst to completely collapse that middle and lower class spending, and that's probably going to be oil. So I would watch oil. Um, I think it bottomed here recently at what, $70. So if we go to $175 between now and next year, that might be enough to where then you're going to want to start looking for signs that the recession has begun.
You mean like next year? You mean like 2024, this like the end of this year, or you mean in like sometime in 2024?
So let's just say a year from that. Let me go check my chart here on oil. I'll tell you
Yeah, it's
exactly when.
probably the summer. You could say the summer of 2023.
So that so we got our final bottom here in May, it looks like May, beginning of May, and it was at $63. So 120. I don't know that $120 would do it, but let's say 150 to $175 by the summer of next year, probably enough to cause the economy to grind to a halt. And then you're going to have a period of months there where where the spending starts to slow down and the economy starts to roll over. So it might even be into 2025 before we really get into the depths of the recession. So it may be a little farther off than people are anticipating. I think a lot of people are thinking, oh, it's already started. I don't think it has. I think we've got to have that final catalyst before it does start.
Here's another question too. I know that obviously you're a huge silver bull, as am I. What indicators are you going to look at to exit that silver investment trade that you put on? What are you looking for a peak or a top in silver when that does
So
eventually come?
So you want to look for signs of a bubble, and they're not that hard to find, but it's not that hard to see or spot, but it is very hard to control greed. when you're in a bubble. Very few people can do it. That's why most everybody gets caught at the top, and then they end up riding the thing all the way down. They lose all their gains. So there are several signs. Every Tom, Dick, and Jane is buying, assuming that they're going to get rich. People that, unsophisticated investors that have no idea, what is driving it. All they know is that their neighbor next door is getting rich, buying real estate or buying Bitcoin, and they want to get rich. So they start buying too. So you get that flood of unsophisticated investors that are just buying because they think they found the goose that lays the golden egg. Also, another sign is that price gets stretched extremely far above the long-term moving averages. So at the top several years ago, Bitcoin, I think was like 250% above the 200-day moving average. And I kept trying to warn people, I'm seeing, all of these kids and people that have no idea what they're doing. They've just bought into the story that Bitcoin's going to 1 million and they're going to get rich. And the signs are there. This is a bubble. You got to take profits. You got to get out of the way. So that's another one. Price stretched a long ways above the moving averages. Silver could be 200 or 300% above the 200-day moving average. When you see those signs, it means you're in a bubble. Usually the initial signs where you start to see the general public starting to buy, when you start to see that happening, you have about a year or a year and a half. It's about how long it takes for the entire public, anybody that's going to buy. And then at that point, you run out of buyers, the bubble pops. And then, you get the people that are stuck on the slope of hope. And, they've gone from being a millionaire one day to you get the initial crash in the bubble. And now their million is worth 500,000. Well, they can't sell because they were a millionaire and they want to get back to a millionaire. So they keep hanging on. They've convinced themselves that it's going to come back. And you get a small bounce. Usually, you get some kind of a echo bounce, and maybe you'll go up to 750, and that's the market giving you your chance to get out. But most people can't. They can't sell because they want to get back to what they had, and so they keep hanging on. And then the 750 rolls over. Your 750,000 rolls over and goes down and goes below the 500,000. At that first, warning shot across the bow, and now you're at 400,000 or 350 or 300,000, and now you really can't sell. It's like, I wanted to get back to my million, almost got there, couldn't sell. Now I just want to get back to that 750, and so you're stuck on the slope of hope, and they hang on all the way to the bottom. And usually it takes 10, 15. In the case of the NASDAQ, it was about 16 years before you recovered back to those old highs. I think the same thing's happening in Bitcoin right now. Bubble has popped. People are in denial. They are anticipating a move, back to those 70,000, I think it was, or close to it. And they still got the vision of $1 million Bitcoin, and they're stuck in a busted bubble that's going to take many years to recover, to finish the base and recover. So when you see that kind of sentiment happening in gold and silver, and your next door neighbor and all your friends at work are buying gold and silver, it's the bell ringing that you're going to have to take profits here at some point because you're in a bubble. And the really difficult part, many people can take profits. They almost always take profits too early, and then they watch it keep going up. And then greed jumps right back on your head, and it says, I'll just get back in because it's still going up. I'm going to get back in for a little bit. And then they get caught when the bubble pops, and then the whole process starts. So at some point when you're seeing the signs of a bubble, you've got to control greed. You got to get out, and you got to stay out, even if you're early and it keeps going up.
And one last thing I wanted to ask you too, just kind of in this phase, would you say this is a correct statement? It is not possible to time the exact top, no matter what you're using, technical analysis or whatever. You just can't do it. So don't expect to get the exact last little bit of it.
Yeah, exactly. It's impossible to, somebody might get it by luck, but yeah, it's impossible to top or to time the exact top. So just at some point, decide that you've made enough money, and when you decide that you've reached that point, get out, stay out. Doesn't matter whether it goes up another 100% or not. Just make sure you don't get caught when the bubble pops.
All right. Do you have anything else you'd like to share with the audience? Anything? Um,
Yeah, nothing I can think of unless you had something else sector you wanted to talk about.
no. And if someone wanted to reach out to you or follow your work, how do they go about doing that?
So I publish some free videos from time to time. I'll put them on my Twitter. It's Gary Savage one, the number one, small g. There's also the Smart Money Tracker blog. Those same videos get posted there. You can just Google Smart Money Tracker and find the premium website and the blog. So if you want to watch those videos, or if you want to go back and look at some historical videos, you can do that. When I think we're close to a bottom and a point where you want to buy, I will open up the premium website to new subscribers. I generally, once I think a bottom is in, I close the premium site to new subscribers, because what always happens is people get really bullish after a move has already run for 3 months, and now they want to get in. Well, now it's too late. Now you're potentially buying at a top, and so you get caught. So I would like to help people not to do that. So I want to let people get in to the S&T when everybody is negative and when we want to buy. And then once I think we've got the bottom, then I close the S&T to new subscribers until I think we're at another bottom. So right now the S&T is closed to new subscribers because I think we've got a bottom in the metals, at least a tradable bottom.
Okay. Well, that's all I've got. Appreciate you coming on the channel here, and hopefully maybe we can have you on in the future. Out a little ways and get updates as we go. But thanks for coming on. Appreciate it.
Thanks for the invite, Andy.
Mhm.